Hey everyone, if you've ever wondered about those pesky interest rates and how you can master the art of negotiating them to your favor, then you're in the right place. Today we're diving deep into the world of interest rates, understanding them, feeling their impact, and learning how to sway them to work for you. So grab your notebook and let's turn those rates from foes to friends. And hey, if you're new here, don't forget to hit that subscribe button and turn on notifications so you never miss out on ways to boost your financial wellness. Let's get started. Types of interest rates. Let's talk about the different types of interest rates you might encounter in your financial journey. Picture this: you're at a cafe and the menu of loans and savings accounts is as varied as the types of coffee available. Each has its own flavor and cost, and understanding them is key to picking the right one for your financial taste. First up, fixed interest rates. These are like the classic Americano of the financial world, steady and predictable. With a fixed rate, you know exactly what you're getting. The interest rate doesn't change over the life of the loan or investment. This means your payments are the same each month, which is great for budgeting. It's like knowing the price of your favorite coffee won't change for the next year, rain or shine. Then there's the variable interest rate. Think of this as the seasonal special drink whose price fluctuates with the cost of ingredients. Variable rates can change based on market conditions or indexes. They're a bit of a gamble. Some days you might pay less and other times more. If market interest rates go down, so do your payments or the interest you owe. But if rates go up, you might find yourself paying more. It's perfect for those who like a little risk and potential reward in their financial lives. And don't forget about the annual percentage rate, APR. This is like the full cost of your coffee, including any extra shots or flavorings. The APR gives you the true cost of borrowing, combining interest with any fees or additional costs associated with the loan. It's a more comprehensive look at what you'll actually end up paying. Factors influencing interest rates. Alright, let's unwrap the factors influencing interest rates like we're decoding the secret recipe to a master chef's signature dish. These factors are the behind-the-scenes maestros conducting the symphony of numbers that determine how much you pay for loans or earn on savings. First off, think of the central bank as the head chef in the kitchen of the economy. Just as a chef adjusts ingredients to perfect a dish, the central bank tweaks interest rates to keep the economy stable and healthy. They might lower rates to encourage people to borrow and spend more, boosting the economy. Or they could raise rates to cool down an overheating economy and keep inflation in check. Their decisions ripple through the financial system, affecting everything from your mortgage rate to the interest on your savings account. Next up, let's talk about your credit score. Imagine it as your financial reputation or rating, much like a credit score from a food critic. Banks and lenders look at it to decide how risky it is to lend you money. A high score is like a rave review. It means you're likely to pay back what you owe, so lenders offer you lower interest rates. A lower score, that's a risky bet, and they'll charge you more to compensate for the risk, just like a restaurant might charge more for dishes made with pricier ingredients due to their higher cost and value. Market trends also play a significant role. Think of these like food trends. Just as demand for avocado or kale can drive up prices, economic factors like supply and demand, inflation, and the state of the global economy influence interest rates. If the economy is booming, interest rates might rise as banks can charge more for loans. In tougher times, rates might fall to encourage borrowing and investment, much like a restaurant might offer discounts to attract customers during a slow season. And let's not forget government debt. When governments borrow money, they issue bonds, which compete with savings and loans for investors' money. If investors flock to government bonds, banks might need to offer higher interest rates to attract savers. It's like two restaurants competing for diners. One might up their game with better ingredients or lower prices to win over customers. How interest rates affect personal finance. Think of interest rates as the rhythm of the financial music that plays in the background of your life. They dance through every aspect of your personal finance, subtly influencing your decisions and the growth of your wealth. When you're looking at loans, whether it's for a house, a car, or education, interest rates are like the tempo, setting the pace for how quickly you'll pay it back. A lower rate is like a slow, steady beat, making each payment more manageable. It means the total cost of your loan over time is less, and you can potentially borrow more or pay it off faster. On the flip side, a higher interest rate speeds up the tempo, increasing the cost of borrowing and making each payment a larger bite of your budget. For your savings and investments, interest rates are like the volume, amplifying or softening the growth of your money. With higher interest rates, your savings account or CDs, certificates of deposit, can grow louder and faster, increasing your financial security and the power of your future spending. But when rates are low, the growth is more of a whisper, encouraging you to look for other investment avenues with potentially higher returns to keep the melody of your wealth accumulation harmonious and continuous. Now, imagine interest rates fluctuating. This variability can affect your decision making, just like a sudden change in music tempo might make you adjust your dance steps. If you have a variable rate loan and rates go up, your payments increase, and you might need to tighten your budget or rethink your spending. If rates fall, it could be an opportunity to refinance debts. Just like a DJ switching to a song with a better beat might encourage more people to dance. Strategies for negotiating better rates. Negotiating better interest rates is like haggling at a market. You need to know the tricks and tactics to walk away with a deal that has you grinning from ear to ear. Here's how you can turn the tables and get those rates down to a tune that sings sweetly to your wallet. First, know your worth and strut it. Your credit score is like your bargaining chip. The better it is, the more power you have. It tells lenders, "Hey, I'm good for it. I pay back what I owe on time." If your credit score is shining, wave it like a VIP pass. Lenders are more likely to give you better rates because they want your business. You're a low-risk, attractive customer. Then it's time to play the field. Don't settle for the first offer you get. Shop around like you're looking for the best deal on a new gadget. Different lenders might offer different rates, and sometimes all it takes is mentioning a competitor's lower rate to get them to budge. It's the financial equivalent of saying, "Well, the other store is selling it for less." You'd be surprised how effective this can be. Don't be afraid to negotiate terms beyond the interest rate as well. Sometimes you might find flexibility in other fees or terms that can make the overall deal sweeter, even if the interest rate itself doesn't change much. It's about the total cost to you, so look at the big picture. Wow, what a journey we've had today exploring the ins and outs of interest rates. Thank you so much for sticking around. I hope you're walking away with valuable insights and ready to negotiate like a pro. If you loved what you learned today, give us a thumbs up and share your thoughts or questions in the comments below. We love hearing from you. And if you haven't already, hit that subscribe button to join our community of savvy savers and bold borrowers. Until next time, keep aiming high and making smart moves.